So on December the 12th, 2022, Disney was trading at around 94.65. Since then, it has fallen roughly 10.5% or $9.96 down to a low of 84.69. Let's go ahead and populate the T3 application. Disney, 50,000 starting capital. We're going to do 3 different positions like this, but we're only going to focus on the Disney trade today. Starting price is around $94 a share. I sold the $88 put strike, 40 implied volatility. That generated $1.80 in premium. I'm going to sell a single put contract or 100 shares and collect $180 in premium. And we're going to have a hypothetical closing price of 88 at exactly the strike price that we sold. And the option is going to expire worthless. Before we go any further, I want to activate the start price, once again, which is $94 per share. I also want to activate the chart support level, which I've identified as right around $85 a share. To do that, we activate the checkbox and bring it up using the spinner buttons here. And there's $85 as the support level. Let's activate the progressive leg break even. This always will show you where you are within the cycle of this T3 strategy as far as your break even is concerned. Let's activate the ending stock value. Let's go ahead and activate the cumulative trade progression. Where do we stand at the end of step 1? We're up $180 based on the premium collected and the ending value of $88, which was the very strike that we sold. Let's activate the outright stock purchase to see how we would have fared had we just gone ahead and bought 200 shares at the starting price of $94 a share versus selling the $88 put strike. Let's activate the dollar difference, options versus stock. As you can see, the T3 strategy is up 180, the outright share purchase is down 1,200, the dollar difference is 1,380 in favor of the T3 strategy. Let's activate both our step and our annualized rate of returns using the T3 strategy. Let's clear out the metrics in the bottom chart. We're going to primarily focus on the top left chart, which really is focused on risk reward. And we'll also take a look at our types of returns that we can expect over each successive step on an annualized basis in the top right chart. Let's assume that at the $88 ending value, it did not expire worthless, rather we had to take assignment of the shares. This immediately drops the strategy down to step 2A, which is a call sale, and step 2B, which is a put sale. We are going to sell the calls against the 100 shares that were assigned to us at the end of step 1. In this hypothetical scenario, the $88 closing price is the carry forward price for step 2A and 2B. We are going to sell the $90 call strike with a 39 implied volatility, which generates $3.15 in premium on a single contract against our 100 long shares. That generates $315 in cash flow. At the same time, we're going to sell a second put sale with an $85 put strike with a 40 implied volatility, which generates $2.59. And once again, it's on a single contract or 100 shares, generating $259 in cash flow. As you can see here, at the end of step 2A and 2B, our progressive leg break even continues to drop, which is exactly what we want. Let's go ahead and add the points differential at the start. What this means is, where are we relative to our break even within the trade strategy? At this point, we are at step 2A at the beginning of step 2. So we collect $3.15 along with the $1.80 that we collected in step 1. We now have $4.96 in credit. In other words, Disney could fall $4.96 without us losing any money. When we add into it step 2B, which is the put sale, that's another $2.59. That brings our credit up to $7.55 at the beginning of step 2. Once again, if Disney were to fall, we have $7.55 cushion before it hits our break-even level. Let's now add the points differential end, meaning on the day the option expires at the end of step 2, how did we fare with regards to our break-even? How close are we? How far away are we from our break-even? And how did it differ from where we started 30 days earlier? Let's go ahead and drop the ending value from the hypothetical $90 per share and see what happens. Let's model an outcome lower than the $90 ending value. Let's bring it down to $85 per share. The $90 call strike that we sold will no longer be called away from us, and the $85 put strike would now be assigned. So let's go ahead and change those two outcomes. And here we have the application populated correctly. The calls have expired worthless because $85 is less than the $90 call strike, and at $85 put strike, we've made the assumption that we took assignment. And you can see that the application is immediately populated, or it's reflected here in all the graphs. So once again, to recap, we started with a stock price at $94, we sold an $88 put strike. It generated $180 in credits because we sold a single put contract, and we took assignment. We said that it finished at $88, and it's populated correctly under the outcome column as taking the assignment. That gave us 100 long shares. In step 2A and 2B, we first off sell the $90 call strike, $39 implied vol. That brings in $3.50 in premium, $3.15 in premium on a single call contract, or 100 shares generating $315 in cash flow. At the same time, with the stock price being at $88, which is the carry forward price from the closing price of the previous option's expiration, we sell the $85 put strike, $40 implied volatility. That generates $2.59 in premium, once again on a single contract or 100 shares. That's an additional $259 in cash flow. We made the assumption that the stock finished at $85 a share. The calls expired worthless, and yet we took assignment on the put strike. We are now long 200 shares of Disney. So we've dollar cost averaged in. We took an assignment at 88 and at 85, and we've collected all these premiums along the way. The start of step 3 has us opening the share price at $85, which once again is the carry forward price from the end of step 2. We're going to sell the $90 call strike with a 38 implied volatility and collect $1.89 for a 30-day options expiration. This time, how selling 2 call contracts against the 200 shares that have been assigned to us at different strike prices. That generates $378, and what we are showing here is a hypothetical $90 closing price. Once again, the exact strike price that we sold, and the shares are called away, and this is for illustrative purposes. If we were to change this outcome from called away, because the ending value was at $90, which was the exact strike price that we sold, let's assume that they expired worthless. And again, the application uses the rinse and repeat model. If the shares are still in our possession, we immediately take the closing price at the end of step 3, which was a hypothetical $90, and that becomes the carry forward opening price for step 4. So now we've gone ahead and sold a $95 hypothetical strike, a 43 implied volatility. That generates $2.57 in premium, or on 2 call contract, or 200 shares, or 2 call contracts generates $514 in additional premium. Now, if the shares were to hit that $95 call strike, the shares in theory would be called away. As we all know, trading is never that simple. Just because we sold the $90 call strike does not mean that it will finish at exactly $90. The odds of that happening are minimal at best. So let's go ahead and drop the ending value from the $90. Let's bring it down to 85 or 86. So here we are at 86. The application is populated correctly under the outcome because 86 is less than the $90 strike. But what's happened is that this ending value at the end of step 3 on options expiration is once again the carry forward value at the beginning of step 4 using the rinse and repeat methodology. So now if I back up and put it back to 90, look at the premium we were collecting by selling the $95 call. We're only 5 points away, and we collected $2.57. But if we drop it from the 90 down to 89, 88, 87 and bring it to 86, the strike price has not changed, just the closing value has at the end of step 3. That becomes the carry forward opening price for step 4, and we still have the $95 strike price in place right here. Our premium collected drops all the way down to $1.39. We are now bringing in $6.44 in premium. When we drop the ending value at the end of step 3, that changes the start value in step 4. We were bringing in $2.57 or $514 by selling 2 call contracts against our 200 shares long. If we reduce the $90 ending value in step 3 to 86, the amount of capital collected or the distance to our break even gets drastically reduced. Let's review that. Here it is. At 90, we were collecting $24. We had a $24 cushion before it would hit our break even. But if the share values drop from 90 down to 86, we are losing on both the share value that we've been assigned on and the premium that we can expect by still maintaining the $95 call strike. Once again, we went from $24.01 down to $10.83. Lower premium, and because we are long 200 shares, we are also reducing how much profit we have the 200 long shares that we hold. Let's go ahead now, since we're using the $86 carry forward price from the end of step 3 options expiration, let's reduce our call strike that we're willing to sell. To get from 86 to 95 in a 30-day window is challenging at best. We've now dropped the strike price that we're going to sell to $90 per share, and that increases our premium that we can expect to collect up to $271. Once again, it was at $139, and we've brought it to $2.71 because we've lowered the strike price that we're willing to sell. You can also see that in the points to break even metric. So here we are now back up to $12.15. We were at $10.83. But by lowering the strike price that we're selling, we get paid more in premium, and that raises our break even to $12.15 away, which is exactly what we're after. If we wanted to continue with the trade by changing the outcome from called away to expired worthless, the application lights up in red. What it's basically telling you is that the outcome is populated incorrectly. If we had an ending value of $95 per share and we said we were going to sell the $90 strike price or sell our shares at the strike price of $90, they would not expire worthless, they would be called away. Here we have it populated correctly, but we're going to model or change one of the variables so that the shares are not called away as yet. We do that by reducing the ending value here from 95 to 94, 93, 92, 91, 90. Now the shares are correctly populated on the strike price, and when it hit $90 ending value, the shares are called away and the trade is complete. Let's go ahead and bring in the cumulative trade progression. This shows us on a step-by-step basis how we were making our money. At the end of step 1, we were up 180. At the end of step 2A, we're up 196. At the end of step 2B, we were up $455. At the end of step 3, we were up $1,033. And at the end of step 4, we're up $2,375. How does that compare to the outright stock purchase profit and loss? If the shares of Disney were to finish at $90 per share and it began at $94 per share, that's a $4 loss times 200 shares. So the share purchaser would be down $800, and yet we finished the same trade effectively, being up $2,375. By adding this metric called the dollar difference, option versus stock, you can see that the T3 strategy outperformed the outright stock purchase by $3,175 by the time the trade was shut down. This metric here is called the percentage profit due to premium. What it's showing you is how much of the $2,375 was earned because of premium and how much was earned because of capital appreciation, meaning after the dollar cost averaging into the shares and the credits collected, when the shares were finally bought away from us at a defined strike price, how much of that $2,375 was premium collected and how much was because the share prices finally rallied and they were called away. As you can see, step 1, step 2A, step 2B, step 3 were all 100% profitable due to premiums collected. But in step 4, about 65% came from premiums collected and the other 30 to 35% came from the price appreciation, where the shares rallied from $86 to $90 and were finally called away. In an ideal outcome, you want to have in either step 3, step 4, or step 5, you want to see this metric drop from 100% down to 70 or even 65, perhaps even 50%. And what that means is that whatever you make at the end of the strategy, you should not be 100% dependent on only the premiums collected. In a perfect world, once again, you would like to get 60 to 65% in premium and 30 to 35% in price appreciation. If you look beside that, you'll see the annualized metric on the T3 strategy. So if you were able to shut this trade down and make the $2,375, remember, this is over a period of 4 months. Month 1, step 2A and 2B represent month 2, month 3, and month 4. So if you were able to repeat this 2 additional times, you would earn an average of 45.1% by the end of the year. If we compare that to the share purchase, you'd be down 12.39%. If you were to repeat the performance, which is effectively losing $800 at the end of a 4-month period. If you repeated that 2 additional times, so 2 more 4-month intervals, for a total of 12 months, you would be losing 12.39% by year's end. And finally, what kind of stress did we put our capital under when the share prices were moving against us? Once again, it started at $94 a share, it fell to a low of $85. That's reflected here. The UI cumulative move. And that was down about 10% on the share price, as you can see right here. On a cumulative basis, it went down to about minus 10%, minus 9.79%. But if you look at how we fared, the percentage move protection, each step of the way that we were able to build into this strategy by selling premium, our downside break even was much, much lower than where the actual share prices had fallen to. And in fact, in the final slide, there's the differential. Only at one point were we ever negative once we entered or began this trade, and that was at the end of step 2A, the call sale. Everything after that, with the premiums collected, it lowers our break even. We were positive or had a 4.6% downside from where it had already drawn down. So remember, Disney had fallen and we had an additional 4.62% below the lowest point, which was 9.79% on the share price. And we had an additional 4.62% cushion to that. At the end of step 4, we had a 9.94% cushion. And by the time we had the shares called away from us, we had a 17.4% cushion from where the share prices were trading here relative to our downside break even. This is the power of T3 and the ability to model what if on a go-forward basis is the ultimate risk-reward tool, especially in volatile market conditions like we've currently experienced going into the end of 2022. Thanks for watching.